Andrew Hollenhorst, Citi's Chief U.S. Economist. Also with us, Bloomberg's international economics and policy correspondent, Mike McKee, and Ira Jersey, Chief U.S. rate strategist for Bloomberg Intelligence. Mike, what is this meant to be about, and what will it be about?
That's a good question, Guy. It's meant to be about the CARES Act. That's how it started. When that relief program was enacted last year, they put in a provision that the Secretary of the Treasury and the Fed chair have to come a couple times a year, or at least once a quarter, I believe, to testify on how things are going with the various packages and what they're doing with the money. And that was extended when they did the latest American Rescue Plan. It'll be the first time that we see Jay Powell and Janet Yellen together. Remember, we saw the Steve Mnuchin and Jay Powell show for a couple of years. But this is really an opportunity for Congress to wander wherever it wants to go. And you can bet there will be questions about things like inflation and growth forecasts. I bet the name Larry Summers will come up at some point. And then maybe questions about the supplementary leverage ratio for banks. So it could be quite broad.
Yeah, I think those are all pretty good bets, Mike. Andrew, when it comes to that inflation part of that conversation, what side of the fence are you on when it comes to that $1.9 trillion in spending that's working its way through the economy? What's it going to do?
Yeah, it's such an interesting scenario to have the fiscal authority and the monetary authority answering questions. And that inflation question is going to be key here. We do see the potential for stronger inflation, not necessarily a runaway inflation, but I mean, we know there are base effects. We know there are energy effects that are going to boost things in the next few months. The real question is, do you get some sustainable upward pressure on prices that continues into 2022? That's what Fed officials are not seeing in their forecast, but we see more potential for that with how rapidly the economy is recovering.
Ira, let me bring you into the conversation. Tell me what the price action is telling you today about market expectations. The oil price is down, yields are moving a little bit lower. Is this just a brief pause before we start to move a little bit higher in terms of the yields? I noted the non-voting Mr. Kaplan from Dallas a little bit earlier on, talking 175, 2%.
Yeah, it wouldn't surprise me at all if by year end we were actually at or above 2% in 10-year Treasury yields. The markets never move in a straight line, and I think this is a little bit of consolidation while the market tries to figure out what the next move both for policy and the economy are. From today, just to continue the discussion a little bit about what we're going to hear from both Powell and Janet Yellen, it's going to be, I think, a lot about what the next response should be after this particular round. But also, I think you're going to hear, and certainly in the prepared remarks, we already have them out, Chair Powell is going to basically, defend some of the actions that the Federal Reserve took, and the supplementary leverage ratio discussion will be part of that. Saying that he unlocked $2 trillion of funding to support businesses and the like by the regulators actually suspending the leverage ratio for both reserves and as well as treasuries. I think the one of the questions that I want to be asked and maybe answered is, now that the supplementary leverage ratio is going back into effect, what might be the different end games that we're going to have with that? Because market participants are very worried about what might happen to liquidity if banks have to shed their treasury holdings.
Ira, I wanted to follow up on that because over the last couple of days, and I think I have a chart here that shows this, we've seen the T-bills on the very shortest end trade negative, and that's been a Fed fear that we see negative rates on the short end that could pull down the Fed funds rate. Is this reaction to the SLR decision? Because I thought that was supposed to raise rates in the short end markets.
Yeah. It probably will eventually raise rates. I mean, firstly, remember the SLR is not in effect and quite yet. That's number one. Number two is banks don't own a whole lot of T-bills, actually. T-bills are mostly owned by other market participants. And what's going on right now is the Treasury Department is continuing to pay down T-bills. So there's actually less T-bills now than there were a month ago. And they're going to continue to reduce them because they have to get the cash balance down to $130 billion by the end of July. And the only way to do that is to basically spend all of this cash that the Treasury Department's built up through issuing T-bills in 2020. So yeah, it's basically a supply shortage. I mean, that's the single biggest thing that's going on with those T-bills. This isn't much different, Mike. Remember from about 10 years ago, from 2011, 12, 13, you had 1 month, 2 months T-bills trade negative on and off for the better part of 4 years.
Andrew, I want to bring you back in here on just kind of the Treasury supply, all of the money coming out of the Treasury, and particularly just the size of the U.S. debt and the deficit now about 16% of GDP. We all can anticipate that Jerome Powell is going to get questions on it. Janet Yellen likely will as well. Are we at levels that concern you?
I don't think these are concerning levels. I don't think they're concerning levels for the market, but that's exactly the question that's going to be asked today. And that's why it's so interesting to have both Powell there and to have Treasury Secretary Yellen there getting their titles correct here, because ultimately the Fed will control interest rates, and what the Fed does with interest rates will determine in large part how sustainable that debt level is. If interest rates move higher, then all of a sudden the debt picture looks less sustainable. So really important here to get a sense of what the level of coordination, implicit or explicit, will be between the monetary authority and the fiscal authority.
I'm really curious how this is all going to work, Andrew. I want to stay with you. We have got an awful lot of monetary stimulus, and we're now going to get an awful lot of fiscal stimulus. It's all being compressed into a very short period of time. We learned today about the idea that maybe the Biden administration is looking for a longer-term infrastructure program, but that's going to take a while and it's going to be much more drawn out. In the near term, there's a lot of money being thrown at the U.S. economy. My question is, what happens next year? What happens in 22, 23? As we start to see this being withdrawn or fading, what economic impact is that going to have?
So I think that's why the Fed, the monetary authority, is trying to be so clear here that support from monetary policy will continue for some time. And we saw that in the last set of projections, where you have an economy that's really, in the Fed's own projections, more or less recovered by the time you're at the end of 2021 to 2022. You have inflation, though, that's not moving significantly higher. And that's the key point from the Fed's worldview, that inflation stays relatively low. So this monetary stimulus, this monetary accommodation does not need to be withdrawn in the near term. The fiscal, you're right, it's very front loaded. We had about $250 billion moved from the Treasury's cash account into individual bank accounts over the last week. That's north of 1% of GDP. So a lot of this is very, very focused in the near term from the fiscal perspective. We'll see if we get more information on perhaps another fiscal package. But right now, I think that's why the Fed, the monetary authority, is being so careful and so explicit about keeping accommodation really on at full blast in the near term.